wage growth and get inflation up towards the middle of the target band, I think that would be an outcome that the RBA would cause the RBA to move as well.
And I know when we're in the middle of a pandemic, it's hard to look ahead. Now, but the RBA is relying, same with Treasury, I guess, that up until now we've had snapbacks. Is this time different? Will these prolonged lockdowns mean that the snapback may not be there by year end?
Well, a typical recession or post-crisis recovery, of course, is typically long and slow because you have lots of structural damage. Lots of businesses go under, workers lose their jobs, their skills atrophy, banks finish recessions with lots of non-performing loans, and so are rebuilding capital, are hesitant to lend. The policy response last year short-circuited all of those. Bankruptcies went down. Long-term unemployment rose only very slightly. Banks, obviously, generally, not just in Australia, but elsewhere, finished the crisis actually with excess capital rather than excess non-performing loans. As long as the policy response continues to do a really good job, I think the snapback view is the right view.
So let's switch gears, and you penned a piece on China recently. It was sort of a bigger step back, whereby China's sort of reinventing itself from growth at all costs to a more sort of global citizen. How long do you expect that to take, and how credible is this path going forward?
Look, I think it's probably a permanent shift. I think the growth at all costs has been under pressure for quite some time. The last couple of years, big development was the shift to putting climate really as a focal point for a lot of the arms of policy in China. And China, unlike some other countries, has very strong domestic reasons for climate. Food quality, air quality, water quality, quality of life. So it's difficult to see China backing away from those commitments or really not following through with them. The most recent shift, I think, has been around the tech sector. I mean, one commentator on shore described it as shifting from a period of barbaric growth to something more sober. That's a big deal on itself. The tech sector, broadly defined, contributed nearly 1% to China's GDP growth in 2018. I mean, I think that was always going to decline, but the shift in the regulatory environment and the policy focus means it's declining much more quickly. You add demographics, a range of other forces in, I think we're not going to see 6% GDP growth in China again.
Yeah, I think that sounds like a good idea, because we know the economic costs of doing so have been brutal in recent years. Thank you so much for your insights today. Richard Yetzinger, Chief Economist, ANZ. Enjoy your weekend.
Thanks.
That does it for the big picture, but stick around after the break. We'll be speaking with SPC Ardmona Chief Executive Hussein Rafay. Come back very soon. Welcome back. Let's have a quick look as we nearly finish that second hour of trading, and we are, I would call that squared in turn the most followed by you on the ausbiz platform. Zip leading the way, and a very mixed picture when it comes to the banks and miners. And so let's have a quick look at next week. The very busy corporate calendar here. Here's a handful on your screen: Cleanaway, Horizon and Transurban. And Challenger, James Hardie, I think it just gets more and more busy. Look at this. The major banks, Telstra and AIG Insurance, all for next week. Now let's have a look at this. Walmart, Facebook, Google, to name a few. What do they have in common? Well, they're all companies that are mandating vaccines for employees. And just this morning, news headlines was that CNN fired 3 employees for coming back to the office without being vaccinated. And closer to home, canned food producer SPC will become the first non-health related Australian business to ban employees from its workplace unless they are fully vaccinated for COVID-19. the mandate is effective from the end of November. So what is the fallout, if any? Chairman Hussain Rafai joins us now to discuss the situation. Good morning, Hussain. Thank you for joining us. Suddenly SPC is in the news. Just walk us through the discussions that took place behind closed doors in order to make this announcement where we are today.
Good morning. Thank you for having me. Look, the issue around the pandemic and the discussion has been something that we introduced our policies and procedures back in March 2020 when first the pandemic came in. We've also invested in equipment for the entry of our site, and we continue to monitor the implementation and the compliance to that policy all the way through. More recently, obviously, as we all know, we have the new variant, the Delta variant, and that's just the next level up in terms of its infectious, in terms of its how quickly it spreads and how quickly one person can infect the other. So obviously, we had to review what is the proper procedures and the proper policies that we need to introduce in there. This combined with the fact that the government opened up vaccination to everybody that's over 18. It's combined with the fact that we've heard several local and international experts that basically say, in no uncertain terms, our way out of this and the only way that we can protect people is through vaccination. The combination of all of that have made sense for us to follow. The only option that we think it would make sense is to actually mandate the vaccine to all of our employees. This is really to protect the employees, it's to protect our customers, it's to protect our contractors, and most certainly it's to protect also the community in which we operate. As you very well know, our largest plant is in Shepparton, Victoria. It's a town of 65,000 people. If we had a breakout coming out of the plant over there, not only we will shut our plant down, but potentially we will shut the whole community down. And we couldn't afford to do that. So the bulk of our employees, we know they're going to do it, whether we've asked them to do that or not. But as in every population, there might be one or two. And in the case of the Delta variant, that's enough for them to basically cause havoc for everyone.
Yeah, absolutely, because you're well away from the CBDs. One Delta variant could cause quite a crisis. I guess a lot of issues with vaccination, besides negative sentiment, is supply. So is the supply there in order for your employees to be vaccinated by November?
Look, the reason why we've given the time frame by November is to allow for accessibility and supply. And we will be working our employees to do that. If our employees don't have access to vaccine, we will be, we're not going to act unreasonable. We're certainly going to work with them to make sure that they have access to vaccine and doing all of that. So this deadline is not carved in stone. If we can't get the vaccine into their arms because of a supply issue, we will work with them. We'll extend the deadline. We'll change the timelines around it. It's basically, we thought, according to all the information that we heard, federal government, state governments, and everybody else, we thought November is a very reasonable time frame. The November time frame breaks into, for the next 6 weeks, all we're asking our employees to do is actually make a booking, just make a reservation. And then the next 6 weeks after that, or 4 or 5 weeks after that, is to get the first jab in their arm and then get the next jab after that. If somebody goes on until, 7th of December or something like that, we're not going to go and sort of say, oh, well, you're 3 days late, there's a door. We're going to work reasonably with our employees. Our employees are just as enthusiastic about getting the jab in and wanting to continue to protect their colleagues and protect the community as we are. It's always a concern about the odd person that is doing it out of, belief or out of this as opposed to out of science. And we are a science-based company, so we had to apply the policy that will guarantee the protection for our employees.
So does that just leave the unions out there? They were of the view that they haven't been consulted. You obviously put a very clear case that this is a community protection decision. Are the unions now on board?
Look, we've contacted the unions. The issue around why they claim they haven't been consulted, and we'd love them to stand shoulder to shoulder with us on this, is that the Delta variant doesn't wait for anybody. It's extremely, extremely infectious. So we'll work with them, and this is not all. We're not sort of saying, oh, by next week we're going to start, firing people if they don't have the vaccine. We want to work with them shoulder to shoulder to get jabs into arms as quickly as possible. But we just didn't have the luxury of time of going through a normal consultation process, so we had to make the decision quickly. Our HR department and our general manager of HR, Robert Tanti, is already working with them. He's already working with our staff. But in certain cases where safety and an issue does not allow us the luxury of time, we as the board and the management have to make decisions quickly. And that's what we did. But we have no intentions not to consult with the unions or not to consult with our employees. We consider them our partner in this business.
And you've also got some big business behind you as well. Well, congratulations on that decision, Hsn Rafay, SBC Chairman.
Thank you for having me.
And of course, we've run out of time, but next up, Nadine is running the call today. She'll be joined by Claude Walker from A Rich Life and Rudy Philibert Van Dyke from FN Arena. Stay with us.
Hi everyone, I'm here to find out a little bit more about sustainable investing, and to help me understand what it's all about, Katie Constance joins me now from Fidelity. Katie, welcome to you. Now, exactly what is sustainable investing?
So sustainable investing, which can also be referred to as ethical, responsible, or ESG investing, is a long-term investment strategy which seeks to integrate environmental, social, and governance considerations into its process. Environmental issues can include climate change, deforestation and pollution. Social issues can include modern slavery and child labour. And governance issues can include executive remuneration and gender diversity. What sustainable investing seeks to do is invest in companies with strong, sustainable characteristics.
Is sustainable investing increasing in popularity?
So over the last decade, sustainable investing has become increasingly important, and there are now over $1 trillion of assets invested in a sustainable manner in Australia. There are a variety of reasons why investors choose to invest sustainably, and that can be to align their investments with their underlying values and beliefs, to diversify their portfolio, or to reduce risk. At Fidelity, our view is that by investing in companies with strong standards of sustainability, we can protect and enhance returns for our clients and contribute to a more sustainable financial system for society as a whole.
Some great insights there. Thank you, Katie.
Thanks, David.
Look out for more of our sustainable investing insights with Fidelity, or visit their website.
5-star investing starts with NabTrade, proud sponsor of The Call. Find out more at nabtrade.com.au/The Call.
Well, good afternoon and a warm welcome to you from ausbiz. This is The Call, a program in which we cover 10 stocks that have been picked by you. I've got 2 expert guests with me today, all over the space of 1 hour. It is Friday, the 6th of August. I'm Nadine Blayney. And of course, because it is a Friday, you may be watching us on YouTube, on Facebook, or Twitter. And if you're new to the program, just an FYI, we do this every day between Monday and Friday. And you can catch up with the program via our website or our app in full, and that includes our stock of the day. And our website is ausbiz.com.au. We hope to see you there. Let me introduce my guests of the hour on this Friday. I know it's a Friday when I see Rudy Philippek Van Dyke from FN Arena and Claude Walker from A Rich Life. How you doing today, Rudy?
I'm counting my luck that it's not the 13th.
Yeah, well, that comes next week, right? And it's feeling a little bit like Friday the 13th here in Sydney, at least. Claude, I saw you made it to the snow last weekend. I've got to say, I was jealous.
Yeah, I'm sorry to elicit that response, but I have to say, for those people that aren't stuck in Sydney, which I realise is not everybody, but it's definitely a strange year, the snow this year with no Sydney people there.
Yeah, and I know some of your tweets that you put out was referencing sort of, how difficult it's going to be for people operating there just to stay afloat, considering the lack of Sydney visitors.
The stuff. So obviously, there's not really JobKeeper. There's no JobKeeper anymore. There should be, obviously, in my opinion. But a lot of the staff that we chatted to, they're having their hours cut right back and everything. So. Yeah, I would be in favour of having JobKeeper so that those kind of businesses could keep going.
Well, before we get too far off our brief, let's bring it to the stock of the day. Look, it's top of everyone's mind, isn't it? The lockdowns that are happening in the Greater Sydney area, the Hunter region, and Melbourne as well. So we hope everybody is staying safe and keeping sane as well. Stock of the day is ResMed. It's reporting season, as most of you well know, and so. We saw the company posting an 8% rise in full-year revenues driven by the ongoing recovery of its core sleep apnea and patient flow across the business as well. COVID-19's, though, continuing, the company annualizing $125 million in COVID-related ventilator sales from this period in 2020. CEO Mick Farrell telling ausbiz that 12 to 18 months ago, the company did a major pivot to produce those ventilators, but it is getting back to its basic business model, and it seems to be paying off.
And in the peak of this now, I would call supply chain limited growth of our industry as we get back and markets open up post-COVID. One of our competitors had a major recall that has produced unprecedented, almost unlimited demand for ResMed products. And we are doing everything we can to open up our supply chain and be able to take care of those people with sleep apnea, COPD and asthma that need our therapy. And on the earnings call that we just finished, I publicly said that we expect to have somewhere between $300 and $350 million of incremental revenue from these opportunities.
So here's a quick check on the instant reaction to that reporting season update from ResMed, down by 1.5% at 12 noon on this Friday. So if you'd like to listen to that interview in full, guys, with Mick Farrell, it's up on the website. But look, Rudy, I'll start with you because, we'll get the deluge coming from the brokers. I've seen RBC Capital's first take saying that the first impression was strong for the fourth quarter, but thought that the additional revenues that the company is flagging in relation to that Philips recall
could disappoint the market. So that's RBC Capital. But I had a conversation with John Lockton from Wilson's Advisory saying maybe not so fast, because in his experience, sometimes these recalls, companies take a long time to recover from these recalls, to pick themselves back up, get to previous levels. So it could be actually a longer lasting positive impact for ResMed. What do you think?
Yes, I think this share price weakness, I think, I also saw that, for example, the market has reacted in a negative way to REA's results as well, by the way. So both stocks, both companies report actually an excellent result, but share price response is negative. I think this is a difficulty for investors to always predict and to assess what exactly is the market response to an actual result. But I think investors need to distinguish the short term from the longer term here. And I don't think it's very clear what exactly has disappointed in the ResMed result specifically. What I do think is probably playing a factor here is that if you look at the share price, this is a longer term share price, but if you look at the share price over the past week or so, you'll find that the share price has rallied quite hard leading into the result. So it may well be that simply some people are here taking profits on the fact, because that gives you a better idea how strong that share price has rallied recently. I would say if you are a longer term investor, don't be put off by the fact that the initial response to the share price is negative. By the way, the share price was negative earlier in the morning. It's already recovering some of that losses. I think if you have a longer term view, what you should concentrate on is this is an incredibly high quality company. It has an incredibly strong market performance. One of the themes that I've been highlighting for this reporting season, and I think which will come to the fore on multiple occasions, is that everyone is focused on what COVID does to corporate Australia. And one of the things that COVID is doing, it is making the stronger. And ResMed is a very strong company in what it does in that particular sector. And the fact that now one of its competitors basically ended up in trouble is, to me, more evidence that the strong are getting stronger. And that is one of the themes that you can play as a long-term investor in this reporting season and beyond. And I think that's certainly something that investors should focus on. Should you buy ResMed at this level, I still think you shouldn't be chasing it, because it really has had a very strong run-up over the past few weeks. But you know what? If you have a longer-term view, maybe the best way to illustrate how you should treat those stocks is, someone on Twitter said recently, if I overpay for a growth stock like ResMed, I might have to wait 6 months to get my money back. If I overpay for a value stock, I might be forced to wait 6 years. And I think it's a little bit facetious, that saying, but I think it applies to stocks like an REA and a ResMed and a CSL and some of those other high quality stocks, of which many are in the healthcare sector. It's always difficult to pick what exactly the point will be, because they never get really, really cheap. But if you are a long-term investor, you end up with a big smile on your face when you have those stocks in your portfolio.
So would you buy ResMed today, or you'd be waiting for a pullback of some sort?
Yes, and I have to say I am a shareholder in ResMed. Yep. It's quite a big position. And I intend to stay on board for a very long time, and I have been, and this is why I wake up every morning with a big smile on my face.
So that's a solid hold from Rudy. John Lockton, I'll reference him again. He's Claude still saw value in ResMed for many of the same reasons, quality company, etc. But he is cognizant of the run-up that it's had lately, but said if you're a long-term investor, it's still not a bad time to buy.
And that's
Claude?
Yeah,
go, Claude.
You pick your point.
Well, yeah, Rudy said it, and I largely agree with that. You can pay up for high quality businesses without risking the kind of disaster that can occur to you when you pay up for lower quality businesses or businesses that are all story or meme stocks or hype stocks and that kind of thing. And ResMed is a high quality business. It's got a long history of growing earnings, and what's more, it's not standing still either. One thing that sort of stood out for me for the interview that you guys had earlier was how they talked about serving the much larger asthma market with cloud-connected pharmaceutical drug inhalers. That is the kind of thing that actually probably could work. And you get a lot of hype stocks, meme stocks that have absolutely nothing to offer, that consistently have some sort of cloud-connected gadget that's supposed to help asthmatics. And it's always just a story. But this company, if you want to sort of invest in that kind of tailwind that, you have more obesity, you have more old people, you have more sleep apnea, but then they also go into other respiratory diseases like more like asthma and stuff like that, which is a huge market because there's also, this epidemic of asthma getting worse for reasons that are sort of debated. But these are long-term tailwinds that should be in favor of the company. So perhaps you can afford to pay up. But having said that, let's just look at a few numbers for a minute. If we take their non-GAAP earnings, so that's the earnings that exclude things that management thinks don't show the underlying business, it's still 50 times that. So it's trading at a PE of 50 times those management earnings, not to mention the actual statutory earnings that are lower. And on top of that, the operating profit was up 8% this quarter. So that's not a lot of growth for a fairly high multiple. So it wouldn't seem obviously cheap to me. It doesn't scream opportunity to me, but this is, as I say, this is a classic father-in-law stock. My father-in-law does own it and has for a long time, and he's done very well out of it. And it's been a star performer, but in part because it's had this good fortune recently, right, of the Philips recall. And if we go back to the Cochlear story, where Cochlear had a recall in 2011, the share price plunged, but that would have been a great time to buy. So if you want to sort of be a little bit contrarian to the market, perhaps, you've seen that gain and maybe there's a little bit more to be gained for sure, but that doesn't necessarily mean now is the best time to buy. So I basically agree with Rudy.
Okay, it's a hold. ResMed stock of the day as reporting season kicks it up a notch here in Australia. Let's get to the companies that have been nominated for discussion by our viewers. This one is for Dion. It is Duratec. DUR is the ticker code. He says they're at a price less than when they were listed, seems to have a good portfolio of works across Australia. I looked into it. It's an engineering services company. Current projects include everything from gold mine remediation to remediation of a cinema in Australia. They seemed like smallish projects to my untrained eyes, but it does look like they're employing drones, and of course they talk about the innovation in this space. Is that enough to get you interested in Duratec, Claude?
Yeah, not on its own, but, and I'm sure Rudy's going to hate this one, so I'm just going to give it the pro case for it, because I do actually think this is a decent company, and it's kind of interesting. Now, first thing I'd note is it doesn't matter where it's trading relative to its IPO price, really. That's just the price they managed to sell it at. So we have to assess it on its merits now. What I think is most interesting about it is that, first of all, it has a lot of work with defense. So that's like the government agency. And I've noticed with a lot of, businesses that do a lot of work with government departments, like that can actually be sort of often kept for many years. So if they can keep that, that will probably underpin, their earnings to a degree. And then the second thing that I think is interesting is that to date, the company says that they've actually completed a replacement of combustible cladding on buildings in New South Wales, Victoria, and WA. Now, if you remember, we have this issue in Australia, which we've also seen overseas, where we have, in our foolhardiness, clad many high-rise buildings with combustible cladding, which is extremely dangerous. And now we have this huge effort to make sure we replace it so that we don't have disastrous fires. So I think that is work that is going to continue on for quite a few years. So, and I suspect that's sort of partly how they've managed to list, right? They've sort of said, hey, we've got a big order book ahead of us, and so, you should invest in us now. Then and then it's profitable as well. But the catch is, and this is why I wouldn't invest in it, is last half they did a 4.9% net profit margin. and that was down from 5.1% in the prior corresponding period. And the balance sheet has 8.3 million debt. They've got 30 million cash, but they also have very large payables and contract liabilities. So that means that their balance sheet, if something bad happened, like if they just lost a contract or a few bad things happened and they made a loss, their balance sheet could suddenly be a major issue. So for that reason, I wouldn't touch it. No way, like not at all. Definitely no. It's not as robust a business as I invest in. Having said that, this is probably trading on around 8 times earnings. It's probably going to pay a 5% dividend yield. This is the kind of stock that, I could totally understand. And when I was younger, maybe it's the kind of value stock that I would be looking at. I can see the thesis for it. I think it's kind of interesting. It's kind of, I like this idea, but I'm not going to take it myself just because it's too low margins and therefore too low quality for me.
So I know you're not going to give it a buy because you don't normally give those recommendations unless you put your own money in it. Is that correct?
Well, sometimes I say buy in the sort of father-in-law way, but for this one, no, I wouldn't say buy to my father-in-law or anybody basically on this one. It's a little bit too risky. I do think it's worth watching though, because there may be an opportunity, right? So I'd call it a sell or a hold list at the moment, but watch it, because if it does pay that dividend, it could get interesting.
Got it. Rudy, is this just too small for you?
Well, that would be one of the reasons. The other reason I think also is that it hasn't had a long life as a listed company, and I've said this before. I wait usually at least 3 to 4 years after listing, because that gives the market and the company the chance to provide some more color beyond the obvious promotion and marketing that goes with an IPO. Apart from the fact that it is quite small, I think, Nadine, you gave quite a good description of the company. It will be one that is a little bit of everything, and that's why it will be one that is more difficult for investors to get their head around. What is this company actually about, or what does it do, and what are the long-term prospects of it? In this context, I can also say, one of the reasons why people like Claude have more difficulties in putting a valuation on a stock like ResMed is because ResMed has a high PE ratio, not because the earnings growth is 8% this quarter. It's because over decades it has done that year in, year out. And because you build up that track record, then the market at some stage says, well, you deserve a premium rating because you've now done so well. The reason why a Duratec hasn't done that is because it has no track record, basically, and it is quite small. It yet has to prove itself. I often see a lot of those IPOs. They start off on a positive note, and you look 6 months down the track, and the share price has halved. I think this is sort of a similar story. It's not always clear why that is, but sometimes it is that the company simply doesn't deserve or still yet has to prove itself. And as an investor, I think you don't have to be there. You can wait your time, observe the company, keep an eye on it, see what management does. And at some point, if it's really, really a good company, there will be lots of opportunities to get on board.
Got it. Duratec. Let's get on to the next one for Tony. Ingenia Communities, excuse me. It is a lifestyle and holiday community builder, across Australia. I thought it was interesting that it's also got this joint venture with a US listed company called Sun Communities. So it's in a joint venture partnership with this company, and then it gets to, it gets paid fees essentially to continue to manage and develop those communities. It's also got a funds management business. What do you make of Ingenia? INA is a ticker code, Rudy?
This might come as a bit of a surprise, but this company has been on my radar for quite a while. In a farther away distance into the past, I think it was called ING something, but that's really a long time ago now. Actually, essentially it's a property developer. It has carved out its niche. It's very interesting in what it does. It has actually been quite a good performer. If you see post GFC, that share price essentially has moved up year in, year out on average, and it is currently priced for that as well. See, this is where I can't place this company in terms of why I should own it or anyone else should own it at this point in time. The reason is as follows. It's essentially a property developer. The fact that it's also a fund manager, it doesn't make it that special, because the likes of Charter Hall, Goodman Group, GPT, you name it, Lend-Lease, they all do the same thing. They all manage funds as well. And this also gives you an idea, like I own Goodman Group and Charter Hall, which are essentially property managers, but in a different format. And I feel much more comfortable in sticking with those stocks than with Ingenia. Not only is this a much smaller company, it's also priced now at a dividend yield of less than 2%. I mean, that's almost like a CSL dividend. And that gives you a little bit of a problem, because growth, I think, is not as strong as for a growth stock, and the yield is too low to be an income stock. So it falls somewhere in between. I'm much more happier, proper English, with Charter Hall and Goodman Group than I would be with this one. So for me, it's a bit of a chameleon that I can't properly place, but it's a very interesting company, I think.
Okay, well, there's others that are sort of in that space as well. Lifestyle Communities, roughly speaking, comes to mind. So watch that space, and Goodman Group reports next week, of course. Claude, you can keep your thoughts short on this one if you like, but Ingenia Communities, INA, not the type of company you invest in. Would you put your money in it for your father-in-law? Or his money in it?
Probably not at these prices, but I actually do. I do have somewhat of an answer to Rudy's question when he says, why would you own it? Why would you buy it? Versus some of the property plays that he likes. And the reason that I've looked at Ingenia for many years, and I think I may have even owned it at one point, is I really like it for its exposure to the aging population and the sort of retiring, the boomers retiring, basically, to put it bluntly. And the reason for that is it is super focused on, I guess, giving an option for, people who are retiring, and they're focused on a lot of holiday home areas where people might want to retire to, and they have like over 55 communities and that kind of thing. And the way it works is actually more ethical. So this is why I kind of like it than some of the other ways it used to work. So there's this idea of a deferred management scheme, or deferred management fee rather, that these sort of older, like a retirement village kind of communities would run. And what it would mean is that when the retirees eventually died and left, they would be left with way less of the value of the place. And Ingenia's model is a little bit different, and essentially is better for the person who lives in their communities, in that they don't have to pay the fee at the end, so their estate is better off. And the quid pro quo is that they buy a house, so you couldn't buy a 2-bedroom house in, a beachy kind of coastal area in regional New South Wales for $380,000 in one of these communities. But then you will have to pay an ongoing per week sort of leasing of the land. So you pay it as you go, but often the people living here may get something from the government, like a pension or whatever. So that covers the rental, and that creates about almost half their income is rental income, right? And then at the end, they can sell that house on, and it's a bit fairer for them. I think it's a decent business model, and I think it's exposed to the aging population, and I think that's why it's done well over the last 5 years. And I think that it may actually surprise Rudy if I'm right that sort of tailwind, and this is small enough for that tailwind to make a difference. I think it's an interesting one. I won't say buy, but I just wanted to give it a little bit of say what the idea in favor of it would be. I'll call it a hold.
It's a hold. All right, we will keep cracking on with this list. Stock 3 is 4D Medical for Ebony. Rudy, I'll start with you on this one. Lung technology, in a nutshell. Exposure to potentially some COVID themes. It has sold some of its scanners, I think 8 something, to the University of Michigan. It's also got clinical trials approved by the U.S. Institutional Review Board. Is this a medical device company that you can get behind, Rudy?
No. Computer says no. And the main reason is it's too small. Under normal circumstances, I would direct people to Pro Medicus, but that share price has blown up to the upside. So I think if you play that theme, you just wait for weakness in Pro Medicus, and I still think, and I'm pretty certain that Claude will back me up on this one. Pro Medicus is one of the prime growth stories on the share market. It's just a problem that between $55 and $60, that's probably a little bit too much to pay for it right now, but the share price should be higher in years to come. So I think for 4D Medical, for me, it's way too small. It has particular risks longer term, and therefore I think you can only take a punt on it at this point in time here.
Got it. Claude, can I get you to weigh in on 4D Medical, please? 4DX?
Yeah, for sure. So funnily enough, just going off Rudy's comments, the reason that I first bought shares, and I own a very small holding in 4D Medical, a very small holding because it's very risky. But the reason I first bought shares in it is because the CEO and co-founder of Pro Medicus is actually on their advisory board. And I just have a lot of respect for him. And I just think that he would only go on the advisory board if he thought that, they really had a great product or a lot of potential. And so that's one of the reasons why I looked at it, and then I thought, well, I'm going to buy a really small holding because I want to make sure. Look, Rudy loves to say it, and it's correct. You don't have to get in early with these things. You can wait. If it's truly a great company, there'll be plenty of opportunities to buy along the way. That is correct. But sometimes what I do is I buy a little bit of a holding, even though I know it's super risky. I buy a little bit of a holding just so it's in my portfolio and I follow it closely. And that can increase the chances that I spot it if it's really definitely going to be good. And that's hopefully going to be, I'll spot that and then I'll actually make a much bigger position. But let me just say, the reason I love this is because, or the reason that I buy it, even though it's so ridiculous, like it's just too speculative to recommend really, is just because, this technology, according to the studies, which, they have of course been involved in funding those studies, but according to the studies, essentially this, the XV LVAS technology that they have can basically be faster, more accurate, and give more resolution than a CT scan, and have less radiation and be quicker. And also, best of all, and this is what you always need with these kind of things, is cheaper. That's what they're saying, right? So if they deliver on their promise, it could actually be something really good. But that's a huge if right now. But the idea as well is also, as an asthmatic, I think a lot about lung disease, and also with COVID causing so much damage to people. I think demand for lung disease diagnosis will only go up from here. So basically, I think there's good tailwinds there. It's a good story, but it's nothing more than a story right now. And I'm just waiting and following and watching and see if they can deliver.
Okay.
But yeah, for me, I own a few shares, and perhaps it's okay as a very speculative thing, but I would hesitate to tell people to buy, really.
Got it. Thank you, Claude. All right, guys, we're at number 4. Latitude, LFS. So Ahmed Fahour finally got this company listed in April after a couple attempts, loans, credit cards, insurance, BNPL. I mean, what makes Latitude unique? Rudy?
Yeah, Ahmed Fahour. I'll keep this one short because I do understand we are a little bit behind time here. Listen, my preference, if you want to go into the alternative financials, my preference would be with Liberty still. Objective observation, Latitude shares are trading well below broker valuations. The implied dividend yield here is 7%. That gives you an idea that the market sort of is not trusting the outlook for this company, or is suspecting there's more risk, or is simply not giving it the kudos it deserves. So yes, you can, of course, jump on board and then think like, well, I have a 7% dividend yield here. And personally, I haven't seen a reason why they would cut their dividends. But history tells me jumping on 7% yields in this current environment is probably taking on too much risk, or you're counting on the fact that the market has it completely wrong, which is a strategy as well. I think out of risk management, you probably go for something like a Liberty, as I mentioned earlier, which gives you next year 5 or 5.5%, and I think has less risk. Just as a little sidestep, the strategy that Claude just described with his highly speculative stocks by buying a little bit and then keeping it in your portfolio because it forces you to pay attention. It's exactly what I've been saying to people in the past, what they should do when it comes to stocks like CSL, ResMed, Cochlear, etc. Because they usually think, I can't buy it, it's too expensive. And I always say, buy a little bit and you'll see how well it performs. It gets you more comfortable in adding more.
Gosh, you and Claude are a match made in heaven, aren't you? Just coming at it from completely different angles. All right, Claude, talk to us about Latitude. There's a lot of these sort of providers out there, and I suppose my fundamental question is, why would you pick this one to invest in?
Yeah, well, I think I'll make it quick as well. Like, I think you've basically made my point, right? There's a lot of these kind of providers out there, i.e. that is like competition, and I don't think there's any moat. And when I got taught to invest, I got taught to look for competitive advantage, moat, high quality stocks. That's the real winners that can be a life-changing difference. Yeah, okay, maybe this is yielding 7%, but this kind of lending is typically super high risk, and it's exactly the kind of stuff that blows up when there is an overall blow up. You want to have something that's going to be, if you're going to invest in a dividend stock, you want it to be one that's resilient when there's an overall blow up, not one that's also probably going to blow up. So yeah, hard pass for me.
Okay, hard pass. That's a new one. I like it, I think. All right. Stock number 5 is 8 Common. 8CO is the ticker code. This is for Chris. Claude, I'm going to start with you because Chris points out this was mentioned last week on the call. I'd like to know more. Over to you.
Cool. Yeah. So 8 Common, I was sort of had my attention last week because it did something a bit dramatic, I guess. It sort of announced that its main expense 8. So what it does is it sells software to large companies and government that like manages their expense management, right? So, and it also it issues cards that they can then give to their employees that, you know, are pre-authorized to spend at petrol stations and restaurants and hotels, but, you know, not at ATMs or something like that. And so it's about expense management. Government is a huge part of its business already. And what it did is it went into trading halt or suspension for about 3 or 4 days before announcing that Expense 8 is the travel and expense management solution for Gov ERP, which will provide a common corporate platform for all non-corporate Commonwealth entities to basically use it. And so basically what they're foreshadowing is they're saying that because they got selected as in this position, they reckon that they're going to basically win a whole bunch new revenue eventually in a couple of years once all those government people sort of start buying through there. And you can see on that chart there how the share price just shot up. It actually went up 100% in one day, which I obviously was quite happy about since I owned shares previously and I still own shares now. But what I must stress here is that the announcement that caused the share price to jump up 100%, you know, that's an announcement that says the first agencies to onboard Gov ERP will be in mid-2023. So they're talking about revenue that they're probably going to get in a couple of years, basically. So it was kind of surprising to me that the share price went up so high. And for me, this is a buy at around 11 to 13 cents. And then it went to 22.5 cents. So I actually sold 25% roughly of my holding there because I thought it was too high. And look, honestly, the company then immediately went into trading halt and raised capital just to private sophisticated investors, no share purchase plan, nothing for retail shareholders. And that's typically what they've done before. And they always end up like raising capital. In my opinion, they often seem to raise capital into share price strength. So they're issuing more shares. They're not keeping the share register as tight as they need to for shareholders really to be well off. And that just shows if they keep having to raise capital all the time whenever the share price goes up, that just shows that their business is still falling short of being mature. So that means that it's still high risk. They're not really doing the right thing by retail shareholders. And they had, you know, it was a bit dramatic to go into trading halt for a week and all of that sort of stuff. So, you know, I'm a little bit cautious at these prices. This is 19 cents now. I don't change my buy price based on what I would pay based on something they might get in 2023. So for me, this is still definitely not in the buy zone anymore, but probably just in the hold zone for me. And I do still hold shares, but you know, I'm sure Rudy's going to highlight some of the risks here for us as well.
Over to you, Rudy.
No. I've got a surprise, Claude. Now, I vividly remember when Claude was on this program and had a 5 to 10 minute rant about the capital raising that Cochlear did in 2020, which was not to the benefit of existing shareholders, which was correct. But he also said, I could never, ever, ever again purchase any shares in that company. And he does it in 8 Common, which we could argue is even worse for shareholders. Anyway.
That's fair.
Bendable principles here.
Well, I was enticed by the potential upside, Rudy.
And there's no upside in Cochlear. What are you saying?
Well, no,
anyway.
Okay. You're right. You've got me there.
I was there for that conversation. I remember it as well. But I suppose when there's money at risk, we can all be a little bit malleable, can't we, Rudy?
Yes, we can be, I guess. And you know what? The short story that Claude just exposed to all of us, I think, for me, it had so many alarm bells ringing. I would say a long berth around it and would not even touch it with a barge pole as far as I'm concerned. And I mean, company has been in business for quite a while. There are companies like EML Payments in the same sector that are growing like mushrooms. And this one basically doesn't do anything, it just raises capital. Why would you ever put money in there?
All right. Listen, my notes are really looking scratchy, but I'll try to do a little bit of a wrap up of what we have heard thus far in the program. So we will begin with our stock of the day. It is ResMed. ResMed is a hold from both of my expert guests. Rudy loves it. He says, just don't chase it here. It's a father-in-law stock for Claude, so he does have it in the portfolio. But again, it is just not something you want to be chasing here. Both agree it's a quality business. Claude likes it. It's still innovating. Let's get to the companies that have been nominated by you. It's an avoid for Claude, for Duratec. Decent company. It's potentially something he would look at in his past life from a value perspective. But it's just not one that he'd be getting into now. It's an avoid for Rudy. It's too small, too new as a listed company. Iginia Communities, look, it's been on Rudy's radar for a while, but he just doesn't see strong. The growth is not strong enough to be a growth stock. Yield is not good enough to be an income stock. He's looking forward to Goodman's Group report next week. Look, Claude likes it. It's got exposure to that aging population narrative, but it's just a hold for him. It's not a buy. Now, for 4D Medical, it's potentially a specky buy for Claude. He sees tailwinds. He sees the opportunity in lungs, but he's saying, wait for it to prove itself a little bit more. It's an avoid, though, for Rudy. No big surprise there. He still prefers Pro Medicus, although that's looking a bit expensive right now. Latitude, it's a pass for Claude. If you're going to be getting into one of these, well, what Rudy calls alternative financials, I like that. He says you want one that's really resilient. And Rudy says, look, there's something up with it trading well below broker valuation. So clearly the market is not trusting something there, not a buy for him. And number 5 inspired some good conversation between the guys. It's a buy for Claude, but only between 11 and 13 cents. So it's not in his buy zone. It's got Rudy's alarm bells ringing, as you've just heard. So there you go. That's the sum up at the halfway mark and beyond. All right, we've got our own portfolio thanks to our partners at NAB Trade. You know the rules. 2 stocks, 2 thumbs up, it goes in the portfolio. We put in Nick Scally yesterday. Weekly, we're up by 4%. On the month, up just under 2%. Year to date, up July 1st, 2021, we're up 2%. Stocks we've added, as I mentioned, Nick Scally, Sydney Airport, Osterco Healthcare, Appin, and Monash IVF. Stocks removed, Evolution Mining, Premium, and McMahon. You can check out that portfolio at ausbiz.co/portfolio. Don't forget, we chat with Gemma Dale each week from NAB Trade at 1 p.m. Gets us across what's been going through the NAB Trade platform, what retail investors are doing. Let's get on with our list, though. This one is from Melinda. It's Bubs Australia. She's pointing out the surge in the share price recently. She says, I know you've looked at this one before, but I'd appreciate analysis at the current levels. It did have a good run up. It has been coming under pressure, guys. Is this, again, just a story, Claude, about travel, about borders, about demand coming from China in particular?
I think that definitely these stocks, the baby formula stocks, do trade on that kind of thing and that kind of expectation. So perhaps that is actually what is moving the share price around at the moment. That's a decent explanation. But to the broader question of whether you want to invest in this business, I think we just need to take stock of the history a little bit of these businesses on the ASX. A few years ago, we had Bubs was sort of a Me Too stock that came in after Bellamy's and A2 Milk were so hot. And you can see there in that chart, it perfectly tells the story how it sort of run up with all the hype of everything. And then as soon as the infant formula trade to China came under pressure, Bellamy's ended up falling by about half and then got taken private. And then A2 Milk, we know the story there as well. That's come way down. And this whole time, Bubs has been easily the worst of these companies, while A2 Milk's actually been like really profitable and for a lot of that time growing profits as well. All these years later, Bubs is still losing massive amounts of money. The cash outflows are phenomenal. This is totally, in my view, this business is it's probably lower quality than A Common, which Rudy, savaged. But this one, it gets through way more money. It burns through way more money. 23 million operating cash outflow in the last year, right? And it has a way higher market cap. So for me, it's 254 million. So for me, the market's still reckons it's going to come good and be massively profitable in the future, which it might. But it's been chipping away, losing money for a really long time. And in the past, it's been a favorable environment to raise capital for infant formula companies when there was heaps of hype around that, but not so much anymore. So yeah, I'd probably avoid it. But yes, okay. I have to say I would avoid it. Yeah.
Rudy, you, Bubs?
Yeah, no, I wouldn't necessarily disagree with Claude. I like the fact that we're now discussing which one is the lowest quality than the other one. I agree with everything that Claude said, and I wouldn't know which one is the lowest quality. But I would never invest in companies like this. They haven't proven anything, and it's all hype and Me Too.
Yeah, well, Rudy, we put Monash IVF, as you've heard. It wasn't us necessarily, but it's in the ausbiz portfolio. Vertus Health, VRT for Jess and Malaya. Both are asking about this one. I know Morgan's recently put an ad recommendation on the stock. Do you agree?
I have a slightly different view on stocks like Monash IVF and Vertus Health. It's similar to Invocare and its competitor on the stock exchange. And I know they do funerals, but these guys basically prey on older women that couldn't get a family together by just having close time with their husbands. And they really prey on that very easily targeted section of society. And I sort of think that's a business model I don't really want to be involved with. So the other thing is to observe is that they both IPO'd with a lot of potential, and that potential hasn't really come to the fore. So I personally am not a big fan. I think there are better themes and more better ESG adjusted stocks to invest in.
What do you think, Claude? It's speaking of ESG getting brought up.
Yeah, I think actually Rudy's touched on an interesting point there. Vertus has traditionally been more focused on the lower cost IVF that can be a lot less successful, and I would actually classify that as more ethically questionable because the woman actually goes through a lot more pain and suffering of having more tries. It's better off to have the really high-end IVF, which costs more, but you have a higher % chance of success. I think that Monash IVF is the pick of the sector. And as a result, I would prefer that than Vertus, and I wouldn't buy Vertus.
Got it. Now, Lovisa, it's impossible to talk about retailers now without talking about extended lockdowns in Sydney, and we'll see with Melbourne, right? So, Claude, Lovisa, it sells little things. It sells little things that it can do online, but it really has to obviously build that side of the business. Yeah,
so this is one of the people that know more about retail than me and invest in retail a lot love Lovisa. So I am reticent to say anything too strong against it because it's considered a really high quality retailer. They can roll out stores, high returns on invested capital. But I also could not give it the buy. I just think it's priced. It's too popular. Everybody loves it as this sort of never-ending growth story. And I just don't know, and I don't trust that the market for this kind of stuff is big enough. And so I at best would have to give it a hold, basically.
Okay.
It's just too popular, too high priced.
I've got my Lovisa earrings in today, just so you know. That's the extent of my involvement. But I did have a good conversation with Luke Laretive from Seneca Financial Solutions earlier in the week. It was on our reporting season masterclass, and he did point out that one of the metrics he's really interested in is cash flow return on invested capital. And he said Lovisa does really well on that scorecard. Rudy, what do you think?
Yes, they do. And they also pretty much acquired a German-based business last year almost for free. I am with Claude on this. I think blokes like us, we don't understand a company like Lovisa. We will never do it.
Well, I'm going to get emails in saying, "Come on, Nadine, are you kidding that we've got to divide companies between blokes and chicks in terms of because it's shopping and little earrings?"
No, but I do think that when Claude and I walk into a shop like of Lovisa's, we don't understand what the attraction is, and that's just a fact. I don't have daughters, for example, and my fiance definitely is not a fan of Lovisa. So my statement stays, blokes like Claude and I, we will never get on Lovisa, but it is very popular, it does very well. I would say wait until the result comes out in August and see what they come up with, because lockdowns somehow must have an influence on them, and we saw that last year as well. Having said so, as long as they can leverage off the acquisition from last year and they can continue to roll out new stores, which essentially is what they're doing, then this share price, of course, should be higher in 12 months' time. But again, don't chase it here, I would say, because I think already a lot is priced in.
Can't teach an old dog new tricks sometimes, Rudy. And, we're supposed to be looking at the numbers. Okay, let's talk about Henson Technologies. I've known Rudy a long time. I can say this to him. Henson Technologies, HSN for Trish. Rudy, there's a takeover offer on the table that values the company at $1.3 billion. So talk us through why anybody would be buying this company at this time.
Well, that's why I'm questioning, basically. Why are you asking questions? The main thing here is the share price is high because there's a bid in there, but the bid hasn't been committed yet. And my understanding is the suitors are doing due diligence here. So I would say, very simple, take the money and run, because if for some reason they decide not to go ahead with the acquisition, then the share price will revert back to a much lower level, and there you're sitting with your missed chance. So whenever luck falls into your lap, don't question it, take it. But don't buy it here.
Yeah, don't buy it here, exactly. So just hold on to it. Let's see what happens with that takeover. Claude, I can't help but bring up the fact that this week started with that blockbuster takeover offer for Afterpay by Square. Do you think we're going to see more M&A in Australia, particularly in the tech space?
Yeah, probably. I'd say so. There's a few good Australian software companies that are big enough to move the dial for like really large companies. So yeah, I think it's possible. But one of the reasons that we usually don't see it is that a lot of the tech stocks in Australia already trade on really high multiples. Henson's been a bit of an exception than that. It's traded on lower multiples historically because essentially it's lacked organic growth. It's only really been growing by acquisition. But this, if it does get taken over at 650, that's a great result. The current, I guess we're in trivia now, but the current CEO is the son of the founder, and he took over quite a few years ago now running the company, and he's taken it from about 80 cents share price to $6.50. So, I think well done, Andrew Henson. He's done a lot to realize value for shareholders there by hook and by crook, just acquiring stuff and patching it all together.
Mm-hmm. Okay, so that's Henson Technologies, Trish. Not a lot to do with that narrative right now. Contact Energy is the last on the list, CEN for Matthew. Now, I was just doing a bit of, thinking about infrastructure-related companies, Claude. They can be defensive, they can hedge against inflation, you can get income, not always in terms of these utilities, capital growth, or am I misreading that? What do you think about Contact Energy?
I guess I don't really like it, but that's mostly just because I figure it operates in largely regulated markets, and so returns are kind of regulated. That doesn't mean it doesn't have a place in your portfolio at all. And Rudy often invests in those kind of companies more than me. The reason that I'll have to say no is because essentially what I'm trying to do with my portfolio is put together a bunch of, I guess, higher risk reward stuff that, overall gives me good returns, even if I have some losses. I don't think that's the kind of, I don't think that's particularly likely with this business. Having said that, regulated returns can be great for somebody that, basically just wants to have a reliable dividend or something like that. So for me, it's a no, and I don't know enough about this one to say, oh yeah, it'd be a good father-in-law stock. So I'd have to just give it a hold, essentially. But mostly that's just because it's out of the kind of play that I'm most interested in.
So Rudy, would you hold Contact Energy as potentially a defensive position in the portfolio?
No, don't think so. The computer says no, definitely. I'm going to show my age here. I'm still old enough to remember when Origin Energy spun this one off on the New Zealand Stock Exchange. If you look at AGL Energy and Origin Energy on the Australian Stock Exchange, that gives you a little bit of an idea of the challenges that are ahead of those companies. They really have to transform. Just like Claude, I do not follow Contact Energy very closely, but I can only assume they have the same challenges. And you sort of see that in the share price. I mean, it is a lot lower than where it was. It has become a lot more volatile. For me, I think the fact that the challenges are so huge and so pronounced for that type of companies, that I think they lose their defensive label. If you look for defensive, you should go for, in the utilities sector, you should go for Transurban, for example, which once economies open up, it becomes a lot less risky than climate change impact related business models. And that's just a very simplistic matter. So for me, it's a big avoid. Managing a portfolio is not just looking at upside, it's not just looking at valuations, it's basically managing risk. And this is the type of risk I do not want to have in my own portfolio. So I would say, don't do it.
Okay, there's a whole investable universe out there. Rudy, I'll say though, we didn't really hit on any of them this time around from this list, at least, did we?
No, the computer says no. It was quite. I could have said that 9 times or so.
Well, thanks for indulging me.
What you need for us to agree is. What you need for me and Rudy to agree is a high-quality growth stock that's big enough for Rudy.
Yeah, exactly. So you guys make a great counter balance towards each other sometimes. Sometimes they agree, sometimes they disagree greatly. Regardless, it's been fun today. It's been informative. Thank you so much, guys, for your time. I do hope you have a good weekend.
Thank you.
Thanks, Nadine. It's been fun.
All right, let's just run you through that last list there. Bubs Australia is an avoid for both of my guests. Just look at the cash burn, says Claude. Vertus Health. Well, interesting that Rudy actually brought up some ESG confines, and Claude agreed. Good point. He goes for the higher end quality IVF company, Monash IVF. Lavisa, well, this is a hold. It's just too popular for Claude. Rudy says he just doesn't understand the business, putting it nicely. He'll wait until August reports are out, and that's because it will be impacted by lockdowns again. Henson Technologies, it's got to take over bid on the table. It's not a time to buy, in Rudy's view. Look, Claude gives the CEO, who's actually the founder's son, props, but says, look, there's no reason to get in now. Contact Energy, it's a no from both of my guests. You just heard why. Claude just doesn't like it. Neither does Rudy, pretty much. That sums it up. Well, for those of you who've been asking about that reporting season event that Kashi's been talking about through the week, and I think it was mentioned in conversation today, you can still watch it. All you have to do is go to ausbiz.co.register. Thought we had it up on the screen, but basically it was a masterclass featuring Marcus Bogdan, Luke Laird, who I talked about today. I mentioned his return on cash flow investments. You can hear him explain it. Scott Phillips from The Motley Fool is my co-host. Eleanor Swanson from Firetrail Investments talking about reporting season, what they go to in a report to understand the company and what it could potentially return going forward. Look, I'm biased, but I think it's definitely worth it. Register to watch ausbiz.co/register. All right, that's the program for today. It's been great to have you along. Keep watching though. Gemma Dale from NabTrade will take you through what's been moving markets this week. Back in a moment.
of reporting season is powered by Pepperstone. Switch to a world-class equity and multi-asset CFD broker.
And hello, it has gone 1 o'clock in Sydney. Time for the Pulse over the next hour. Well, we're going to bring you lots of information, hopefully to make sure it's easier for you to make a decision on buying, holding and selling in the current market. I'm Andrew Gagan. Great to have your company this afternoon. Let's check the local market, see where we're heading at the moment. In the final session of the week, down around 1/10%. At this point, it's been a bit choppy, as you can see, throughout the day there. Just getting to some of the sectors that are moving. The miners certainly in focus at the moment. In fact, we've got the biggies there just as far as where that iron ore price is looking a bit bearish at the moment. BHP, Rio, Fortescue, all down.